way to live with it effectively, and economic activity will flourish. I don't believe we're in a new paradigm where the world will be fundamentally different, but it's going to take some time to move forward. In the context of that, I think that monetary and fiscal policy on a go-forward basis will have a bigger impact on the trajectory of markets than the pandemic will from this point forward. That doesn't mean there won't be periods of time where in the short term, a variant can flare up. There's news that affects markets in the short term. But the bigger issue to focus now is we've had unprecedented monetary and fiscal policy for a meaningful period of time, and we're going to emerge from that and unwind that. And that's going to have an impact. It's had a big impact on asset prices, market activity, and a variety of things. It's going to have an impact on those things as we unwind it and find the balance. And the thing that I don't have the answer to, none of us have the answer to, is can that be done in a smooth way where we take a little bit of the air out with not a lot of bumps and volatility, or are we going to have some bumps and volatility along the way?
Okay, you spend a lot of time talking to the CEOs of corporate America and around the world. And so when you talk to them about this and really talk to them about the issue of valuation, oftentimes about their own stocks, because they're thinking about whether they should be pursuing different transactions, what their own values are. What are you telling them at this point? Is this a fairly valued market? Do you say, look, you're valued very highly. Take advantage of the currency now. I mean, what's the thought?
Well, there's no question that looking at the market broadly, valuations are full in any historical context. And so if you're talking to companies that have a very, very strong currency, you're certainly encouraging them, if they have aspirations, to deploy capital and put that capital to work. This is an interesting time to think about it. Also, for most companies, borrowing rates and the ability to access capital through debt finance has never been cheaper. And so it's been a very, very good time to think about investing in business and deploying capital. I think it depends on the company and the particular company that you're talking to. I think the market has been very enamored with growth at all costs.
Right.
And I think we're seeing a little bit of the momentum come out of that over the course of the last couple of weeks. A lot of these businesses that have very, very strong top line growth but haven't yet proven whether or not the business model really generates earnings over the long term, I think those are going to be a tougher slog. And I'd encourage those companies to make sure they have the capital in place to execute on their growth plans while that capital is available. I think some of that can rebalance in the coming months, over time. But it's not one size fits all. And you can look through the spectrum of the market and you can see different valuations for different businesses.
When you look, though, at what's happening, for example, in the IPO market, or frankly, the SPAC market, is that something that persists and continues apace? Do you feel it's slowing down? Do you feel it's speeding back up again? I mean, we've sort of had this undulating roller coaster.
There's been some undulation, to use your word, but there's no question SPAC activity has come way off its peaks. SPACs are good capital markets innovation. They're not perfect. There's been an evolution in disclosure in the process around SPACs. I think SPACs are here to stay, but I don't think we're going to regularly see the volume of activity and the surplus of activity that we saw in the early part of this year.
And when you talk about inflation, again, with clients, are you in the category of cash is trash and inflation's going to make that cash, not just worthless, but worth less? Or are you in the category of you might actually want to keep a little bit because there might be an opportunity coming?
Well, once again, not black and white. I do think that we've lived for a long time with inflation below trend. And I think one of the things that I'm concerned about, or I think about a lot, is people have kind of lost a historical perspective on what markets look like and what is normal. From a monetary policy perspective, what we've had over the last decade is truly unusual. And I remember, and I know historically, I've been around doing this, since the 1980s. I remember when we had a very, very different environment, and we could have a different environment again. And so I do think that while we've had inflation below trend for quite a significant period of time, there's a reasonable chance that we're going to have inflation above trend for a period of time. Doesn't mean it has to be like this. Could be, doesn't have to be. But when you think about periods where there's inflation hurts asset prices and it slows down your ability to make money with almost any asset. From 1970 to 1980, there was almost nothing you could own where you made money. Basically during that 10-year period, oil and gold. Cash, you lost money. If you own U.S. equities during that 10-year period, you lost nearly 50% of the value of your holdings. So people forget the historical perspective. It wasn't too long ago, in 2004 to 2006, I think it was June 2004 to June 2006, that as the Fed normalized rates, they hiked 17 times in that 2-year period. Now, I'm not saying that's going to happen, but I think we're living in a world where people are forgetting the history, and this might be a period that's different, we could go back to another period that looks materially different from this. And so I think you've got to be cautious and manage your risk appropriately for the distribution or the chance that that might happen.
What do you think about bank valuations? Your bank's done quite well recently.
Well, like any other CEO, I think that my company and my stock is underappreciated and undervalued. There's no question there's been a markup in bank valuations. I think the earnings power of the traditional financial services sector is quite powerful, and we get a very, very low multiple on those earnings. I think there's a perception because of the last 10 to 15 years that there's greater volatility in that earnings stream than I think there is at this point. That doesn't mean that there can't be volatility in those earnings streams, but I think that as a group, there's much, much more fee-based, durable, recurring revenue. I think that we're working on shifting our mix to continue to increase that. And I think at some point in time, there's still upside because the earnings power of these institutions, the franchises that they hold, is really quite powerful.
What do you think about fintech valuations, on the other hand?
I think that fintech valuations at the moment project a view of the future, because there are very few fintechs that actually make money at this point in time. To the degree that some of these platforms turn out to be sustainable platforms that really have business models where they can make a lot of money, some of them will look to be cheap over a period of time. To the degree that they can't convert to a business model that can actually make money, they'll be absorbed or they'll go away. But I think it's a mixed bag. And what's clear to me is some of them will be a huge success, some of them won't. But I also think the incumbent players, there's a big disruption going on in the digitization of financial services and how they're delivered, whether it's to institutions or to individuals. And I think the incumbents are going to play a big role in that. And I think upstart fintechs are going to play a big role in that. Not everybody's going to be a winner in every way, but the market's probably ahead on some, but not ahead on others.
I want to talk crypto in just a moment, but Becky's got a question. Sure. Bex?
Hey, David, great to see you this morning. Thanks for joining us. We had a big debate in the last hour just about back to work and whether getting back to work or working from home is going to be the future. There's differing opinions out there. I know you have been somebody who thinks it's really important to be in the office, so I'd like to ask where you think the majority of office places are going to be, let's say a couple of years from now, maybe when the job market shifts a little bit and it's not quite as competitive. And will those offices be in places like New York City?
So first, Becky, it's great to see you and appreciate your having me on. I think this is a complex question, and my view on this, and I talked to Andrew about this a couple of months ago when we were together at an event. I've been very focused on Goldman Sachs and what's right for Goldman Sachs and what Goldman Sachs needs to do to continue to serve its clients and be super competitive in our business. For our organization, which is an organization where 50% of the people who work at Goldman Sachs are in their 20s, we need to come together. We're an apprenticeship culture, we collaborate, and we need to come together. That doesn't mean that there can't be flexibility. That doesn't mean the technology can't lever that flexibility. But generally speaking, for our organization, we need to come together. I think in most businesses, collaboration is important, but every business has to determine what's best for that business to serve their clients or their customers, to compete, to retain their talent. I'm talking to a lot of our employees who are in their 20s. They don't want to be sitting at home in a small apartment. They want to be with other people their age. They want to be collaborating. They want to be learning. They want to be in touch. And so every company is going to choose its journey along a path to how to get back to work. I'm not good. I don't have a crystal ball to say where everyone comes out. But generally speaking, we're social creatures. And I'd be cautious about interpolating forward, a permanent state based on what we see at the moment.
What about New York City?
Well, I think in New York City, one of the reasons why I'm an advocate here in New York City, I think it's very important for the economic vitality of New York City to get people back into the city and get people back working. If you go through Midtown during the day, it's getting a little bit better, but think about all the small businesses and all the organizations that are still under enormous pressure because we don't have that economic ecosystem where people come during the day. So I think for big urban centers, they have to be attractive. You have to bring people in. There's got to be a balance. I think technology allows more flexibility, but generally speaking, I think it's important for New York to continue to bring people together. And I think one of the strengths in New York is that young people want to be here. And I don't think young people want to be locked in their apartments. I think they want to be here. They want to participate, go out at night. The city's very, very busy. And so I think we're in a transition to getting people back engaged, and hopefully we'll make more progress over the next 6 months. But I think it's very, very important for economic vitality in the city.
By the way, what do you think of Eric Adams?
I'm excited about Eric Adams, and very, very hopeful that
I know
he's
you
going
were
to
worried. You were worried about the city, though.
lead the city forward. Well, I'm concerned, and I said this, publicly, recently. History will tell you that no city's place in the world is permanent,
Right.
and it's important that that all cities are attractive for business and for people to live. And cost of living, the vitality of the city, what the city offers, taxes, all those things go into an equation that either attracts and retains and sustains people, or at times put pressure on that. And
what's your bet on New York?
Well, my bet on New York, and I said this clearly when I was interviewed about this, New York's not going away. But there's no question that safety, security, cleanliness, these things matter. And I'm really hopeful, and I've heard from the mayor-elect directly, that he's going to be focused on these things. And I think these things matter in any urban center.
Before we were talking about fintech, I said I'd get to crypto. Has the Solomon family changed its view on crypto? Do you own Bitcoin or Ethereum personally?
I don't personally own Bitcoin or Ethereum, and I don't have a strong view. When you say I've changed my view, I don't know what you think my view is. My view on Bitcoin, for example, is I really don't know, but it's really not something individually that's important to me.
Right.
I'm a big believer in the digitization that is occurring and the disruption that's occurring in the way financial services are delivered, as I said to you, both for institutions and for individuals. I think it's a massive shift. We're trying to participate in it based on what we're doing around Goldman Sachs Marcus and our digital banking platform.
But do you want your clients in it?
I'm sorry?
You want your clients in it?
I want our clients to do what they think they want to do. As a speculative asset, is it interesting, and are some of our clients participating? Absolutely. But whether it goes up or down, my guess is, look at the last week. It's going to go up, it's going to go down. I don't know what the permanent state of Bitcoin is, but I think Bitcoin is really not the key thing. The key thing is, how can blockchain or other technologies that are not developed yet accelerate the pace of the digitization of the way financial services are delivered? And I just talked to you about our digital bank. You know that we just made an announcement out at AWS reInvent about a platform, the financial cloud, that we're building in partnership with AWS for institutional clients. All of that is the changing of the digital processes that kind of lubricate the way financial services are delivered. And I think that's a big opportunity, and we're excited about that.
And that gives your clients almost direct access through APIs and such into the data set that is Goldman Sachs. Joe's got a question for you.
Sure. Andrew, I know you got a lot of places you want to go. David, it's good to see you. We could do this for probably longer than an hour, but just real quickly. So rates are probably, after years of what we've seen, they're probably headed the other way someday. Is Goldman Sachs factoring in a lower average return for equities over the next 3 or 4 years than we've seen for the past 3 or 4? It's just a simple question. Do you think it has to be that way? Are we back to like mid-single digits, maybe?
So Joe, I would never say it has to be, because has to be is stronger than I would make it. But it's certainly, we would expect that we're not going to see the same rate of returns in equities and many other assets over the next few years that we've seen over the last couple of years. It's been an extraordinary disruption in markets. And in the context of that, you've seen some skewed results. And so I'm not a believer that double-digit equity returns compounding in perpetuity is something, as an investor, you should expect. I've been involved in a number of investment committees and charitable foundations, college board, et cetera. And certainly my mindset is the returns we've received over the course of the last 3 to 5 years are different than what we should expect as we go forward from here.
While we have you here, also wanted to ask you a little bit about China, because it's a controversial topic. Goldman Sachs has spent a lot of time trying to build a business, and you are committed to building a business in China. And yet we're at this moment where a lot of people are looking at the human rights issues that are taking place in that country and thinking about what is the role of an American business, oftentimes vocal American businesses here, when it comes to ESG or voting rights or all sorts of other issues. You've been very outspoken about gender equality, for example, and yet doing business in China at the same time.
So the geopolitical relationship between the U.S. and China is very complex, and that's going to continue for sure. We've been investing in our business in China for a long time because China is a very important part of the economic vitality of our world broadly. And we have clients that we serve around the world that are clearly exposed to economic activity all over the world, and we want to continue to serve them. I think when you think about policy actions, it's not our job as a private enterprise to set policy actions, but we watch appropriately, and we obviously will respond to policy actions as they're set. I obviously don't like the human rights violations that I see in that part of the world. But I think that from a policy perspective, we have to strike a balance across this because we're very economically entwined, and it's not simple. There are places where I think we have to cooperate, and I would point to climate as a great example, and I can highlight, for example, a green finance working group that we're involved in establishing that's got both public and private sector leaders coming together with a particular focus on China's transition. And then there are places like human rights violation where we have to confront and try to get a different result. But if people are looking for a black and white answer, I think that's going to be a very, very hard execution. But we've got to continue to focus on this because we're very economically entwined.
What do you think the role, though, of business is to speak out or not? Can they speak? Can a business leader speak out on a human rights issue, for example, in China? I think, for example, Adam Silver at the NBA has tried to thread this needle. Ray Dalio was on our air last week trying to thread a needle, and it didn't work. Elon Musk was speaking at the Wall Street Journal event last night, very pro-China, and I think there were a lot of people who were critiquing him, saying, does he feel he can't say something critical of China because he has so much business in China?
So I can't speak for everybody else, but I generally try to stick to business, and I leave policymakers to set policy. And I just commented. I said to you, I don't approve of the human rights violations that are going on. And so that's a point of view, but it's not my job to set policy. We need government to set policy. We need them to legislate. We need them to interact in that geopolitical relationship. And it's our job to balance and run business based on the parameters that are set up. And I think Joe said this, or somebody said this on your show earlier this week. If we got into a debate of everything that goes wrong somewhere in the world every day and how business is responsible for that, we get ourselves to a very complex place. I don't think any of you are advocating that's where we want to go.
We got to let you go. I know you got a big conference today.
We do. We've got our financial services conference here, where we've got a broad group of financial services companies here with investors, and so that should be an interesting day, and a lot of discussion about some of the things you and I were talking about: digitization, crypto, changes and disruption to the way those services are delivered. So we're looking forward to that.
They're playing the music out. You're a better DJ. I do have to. Barry Manilow. That's what I said. I listened to the podcast. He did a podcast last week, guys. And Barry Manilow is
my dad. No, my dad loved Barry Manilow, and unfortunately, my dad's not with us. And so sometimes when I hear Barry Manilow, I think about my dad. It's a great memory.
David Solomon, thank you for joining us this morning.
Thanks a lot. Good to be with you all. Thank you very much. Good to be with you.
Coming up, a lot more on Squawk. News in the last hour that American Airlines CEO Doug Parker, he's planning to retire, and President Robert Isom is going to be taking the reins March 31st. We're going to speak to both gentlemen in just a couple of minutes right here on Squawk Box. We're back after this.
At Nuveen, we believe income investing can benefit both investors and communities. For over 120 years, our income-focused strategies have been building roads and bridges, hospitals and schools, and helping small and large businesses to grow. Investing to make an enduring impact on our world.
Our energy technologies have been able to power factories, military bases, and plan communities with fully sustainable energy. Couldn't we do the same for the most energy-dependent industries of today? We've emerged as the leading sustainable digital currency mining company in the U.S., transforming solar, wind, nuclear, and hydropower into one of the most productive and fastest-growing Bitcoin mining operations on the planet. CleanSpark, Bitcoin mining for a better world.
Opportunities are all about timing. So now that Medicare annual enrollment is here, it's time for a plan that gives you more for your Medicare dollar. An Advantage plan from United Healthcare. Call United Healthcare today to get $0 copays for primary care doctor visits, $0 copays on preventive dental, and $0 copays and deductibles on Tier 1 and mail-order Tier 2 prescriptions. Last year, our plan members saved an average of over $9,000. You'll even get free yearly eye exams and designer frames. Now's the time to get more from your Medicare plan. Don't miss your shot. The opportunity comes once a year. Enrollment ends December 7th.